Good afternoon, or possibly good morning. I want to thank everybody for logging in and calling into our webinar today. At Advanta IRA, we always like to try to bring different investments and different investment ideas, I guess, to the forefront to really make people more aware of different things you can do within your self-directed IRA account. So today's webinar is featuring a guest who's going to talk about merchant cash advances and how you can invest in those with an IRA account. So we'll be bringing that guest on in just a few moments. But I want to make sure that everybody who's listening live today to the webinar, if you have any questions as we go along, you can certainly type your questions into the box on your screen, and either myself or the guests will make sure we get to those questions prior to the end of the webinar today. So again, if you have any questions, just type them into the box. If you are listening to a recorded version of this webinar, jot down your questions. My contact information, as well as our guest host, our guest presenter, I should say, will be available later. We'll make sure we have that out in front for you. Just a little bit, a quick background on myself. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company for a number of years, wore a couple different hats during my time here. I've focused really primarily now on the education aspect of our business and letting people know what's possible with a self-directed IRA, what you can do, the different possibilities. So we do a lot of different speaking engagements, and I oversee the offices that we have in both Tampa and in Atlanta from that perspective, really that new business development. My educational background, I'm a licensed attorney in the state of Florida. I do not practice and give any legal advice, though, for any Advanta clients on issues relating certainly to their IRA accounts, and do like to provide our disclaimer anytime we do a webinar that at Advanta IRA, we do not provide legal, tax, or investment advice, and we certainly do not endorse any products or are not affiliated with any other companies, including anybody that we might have on as a guest today in our presentations. So if you need legal or tax advice, that type of information, we can certainly refer you potentially to an attorney or a CPA who can assist you with that. And if you just reach out to us, we'll give you those advice. But again, the important thing is when it comes to due diligence and choosing an investment, it is up to you to do your own due diligence, do your own research to make sure you know what it is you're getting into with a self-directed IRA account. Quickly about Advanta, if you're unfamiliar with Advanta IRA, we are a self-directed IRA administrator. I'll talk a little bit more about that in just a moment, what that means. But we hold over $1 billion in assets. We have an account manager system for every new account that we have here at Advanta. You get a personal account manager, someone who will know you, know your investments, and someone you'll be able to reach out to with any questions you have regarding your account. That's something that's unique in the industry that our clients have certainly found over the years to be very beneficial, to have that one point of contact and not simply call an 800 number whenever you need anything regarding your account. At Advanta, we're not only committed to the customer service aspect of our business and really making sure that individuals are well taken care of in their accounts, but also the education. And again, today's webinar is part of our commitment to providing quality education to our clients, to prospective clients as well. We do those through the online trainings like the one you're listening to today. We do live seminars in our office is in Atlanta and Tampa. Also, we are frequently out in the community as well, doing events, different networking events. Sometimes we're speaking, sometimes we're just there attending. But we're trying to get the word out on self-directed IRAs and really make sure people are aware what they're getting into when they're looking to self-direct, what the rules are, and certainly what's possible is I think really what the huge benefit is when you talk about self-direction. Again, that's part of what today's webinar is, to show you just another way you can invest within your IRA account. So go to our on-demand page channel. We have a channel on YouTube. All of the recordings for all of our webinars, including the one that you're listening to today, is posted on that particular site. So visit our homepage to get to our YouTube page from there as well. Now, for anyone who's on the webinar or who's listening to the recording who's not heard of a self-directed IRA, very quickly, very simply, a self-directed IRA is an account in which the owner of the IRA, the actual, you as if it's your IRA, you have control over what investments you're making. You're not being limited to those assets, those investments that are being managed by a brokerage firm or a financial advisor who's offering you maybe a number of different mutual funds and stocks, but but ultimately those assets are all tied to the market, and you really don't have control over choosing any other type of an investment. You're pigeonholed there into what investments your particular custodian is going to offer you. Self-directed IRAs in general, we see a lot of clients hold various real estate, mortgages, notes, private placements, et cetera. We'll go into a little bit of that more in just a moment. But as far as what is the motivation, so obviously people wanting to self-direct can use our services to invest in a number of different assets. But what's kind of driving them to even to go down this path? I think usually people fall into one of these three buckets that you have, and for some clients and some investors, they're choosing to self-direct because their IRA is simply providing them a new source of capital. They've identified the next rental property they want to buy, or they've come across an investment opportunity that's too good to pass up, and their IRA is simply providing them a new place for which to actually fund that investment. So rather than dipping into savings, taking out a home equity line, something like that to make an investment, they're simply putting their IRA to use outside of the mutual fund and stock market to take advantage of an alternative investment. For a number of clients, and certainly this is true, I think, in the current times that we're doing this webinar today in the beginning of 2019, some individuals have stock market fatigue. Ups and downs, geopolitical events that are influencing your IRA, your 401k account that you have no control over, and that's you can't sleep well at night because you wake up each morning afraid to see maybe what the market's doing that day, because that's where your funds are invested. So some people that's their motivation. I need to get my money out of that type of an account and somewhere where I know that it's placed, somewhere that I can trust my investments are being well taken care of, or at least again something that I have control over. And for some individuals, it's a tax benefit. When you invest through an IRA account, the benefits, all the profits that you make, the rents, the dividends, go back tax deferred or possibly tax free if you have a Roth IRA, back into your IRA account. So certainly those tax benefits extend to everyone who is using their IRA, whether they're getting away from the stock market or whether they're just accessing their IRA as a new source of capital. Now, the types of accounts that can be self-directed, I'm not going to go into detail about these particular accounts, but just know that any type of IRA, whether it's an individual, traditional, or Roth IRA, whether you own your own business or you're part of a small business and have a SEP or a simple IRA, any type of IRA can certainly be self-directed. We also offer solo 401ks here at Advanta, and any former employer plan. So if you worked for a company or you worked for the government and had a 401k or an old 403b plan, those monies can also be self-directed if you simply take the step to do a direct rollover of those monies into a self-directed IRA account. Now, the only plans that, generally speaking, cannot be self-directed, or at least where there are restrictions in place, are current employer plans. So if you are currently working for the company sponsoring your 401k, they can limit you to moving the money out of that account and into a self-directed plan. Now, sometimes there are some exemptions or exceptions to that in situations where you can move money out. So you just call your 401k administrator to find out what options you might have. Now, if you are looking to self-direct, one of the common misconceptions that happens when people are looking at investing in an alternative asset with their IRA is they feel that they're going to have to take the money out of their IRA as a taxable distribution, and you're taught by your financial advisor and your CPA, to not touch your money inside the IRA account because you don't want to have a taxable event. You want that money to keep growing tax deferred or tax free. So when individuals go to their financial advisor and say, hey, I want to buy a piece of real estate, or I want to make an investment into a private placement, the advisor thinks that you are taking a distribution and warns you with the various penalties and taxes that you might pay in order to pull your money out personally and then make the investment. What those advisors typically don't understand and realize is that you're actually making these investments still underneath the IRA umbrella. And you can transfer or do a direct rollover of funds from either an IRA or an old 401k directly into a self-directed IRA. There's no tax consequence whatsoever. The money is staying underneath your retirement plan umbrella. It's not touching your hands, and therefore it's not taxable. So when you move funds, we help you at Advanta, either doing a transfer or a direct rollover to that particular account. You can do partials, you can do them in any amounts, and you can oftentimes do them as often and whenever you would like to do it. So there is no limitation on moving money between different IRA accounts. Now, again, I kind of mentioned earlier some of the types of assets that we see that are self-directed. A lot of assets that we have at Advanta are tied to real estate, whether that's rental properties, rehabs, or flips. People investing in multifamily. We see a number of individuals investing in private placements. Private LLCs that maybe you have to be an accredited or sophisticated investor to invest in a hedge fund or a private equity partnership. You can certainly invest in gold and silver, precious metals, commodities, other types of various assets. And then another big category, and that's a little bit of the focus, be a little bit of today's webinar, is in the area of private lending. So your IRA can be a lender to somebody else. Actually, have your IRA act as a bank, and we do a whole different class on that. If you go to our YouTube page, you can find the link. Where your IRA can act as a private lender, whether it's an unsecured note, whether you're in, just a simple promissory note that someone signs, or whether they're giving you a mortgage to a piece of real estate to secure it. You can invest in accounts receivable. And also, again, as the main focus of today's webinar is, you can also invest in a merchant cash advance. And again, we'll bring our speaker on in just a moment to talk specifically about what those are. Now, the common thread with all of these assets is that brokerage firms won't hold them. Charles Schwab, Fidelity, Edward Jones, you name it, those companies, that's not their business model. Their business model is to sell you mutual funds, stocks, and other assets that they sell. And so they're not interested in holding these types of assets for your IRA. So if you're looking at doing private lending, your brokerage firm account is not going to hold it. Now, in general, why do people choose to do private lending out of their IRA? Again, the ability to act as the bank and in many cases determine the terms. You can then set the rate at which your IRA is growing. You know that if you're getting an 8 to 10% or 12% payout every month, then you know exactly how your IRA is growing year to year and month to month. It can be a low maintenance asset as opposed to buying an asset like a rental property or like a rehab, where you're having to manage that particular project on a monthly or even probably weekly basis. Private lending, you lend the money out and you make sure you just get your payment back once per month. So it doesn't have to, it's not a high stress asset. It can be something very easy to get set up and get going. And again, in many situations when you're doing loans, you're acting as the bank. You get to decide ultimately what those terms are. How much are you willing to lend? What the interest rate's going to be? What the length of term is? How long is my money going to be sitting out there for before I get paid back? Is there any amortization? So again, I think that's something that's these factors are all very attractive when it comes to private lending. And so, like I said, we brought a guest on today to talk about a specific type of private lending, merchant cash advances. And I want to bring on at this time Elliot Goldberg to talk about these particular assets. Elliot, are you there?
I'm here. Thanks, Scott.
Okay, great, Elliot. Well, you should have control over the slides. Elliot is the manager of 1931 Funding LLC. He's an independent registered investment advisor as well. Is born in New York City. I won't give you his whole bio because I'll leave Elliot. I'll leave that to you as well. And again, I would encourage before Elliot gets started, if you have questions as we go along, especially for Elliot or maybe something I've already covered, get those questions asked in the box. One, someone did say, "Is there a copy of the slides to download?" We will. They're not downloadable here, but we will be sending a copy of the slides out to everybody as well. So again, any questions you have as you go along, please get them typed in. We'll make sure we get those asked of Elliot. But Elliot, at this point, I'm going to turn the presentation over to you.
Great. Thanks, Scott. Hello, everyone. My name is Elliot Goldberg, and I am a registered investment advisor. I own and manage a fund that invests in merchant cash advances called 1931 Funding LLC, as you can see. My goal today is to help educate you on this unique alternative investment class so that you can determine if it should be part of your overall investment portfolio. So let me move on here. Couple of disclaimers, just like before with Scott. It's just for informational purposes. Information's been obtained from a variety of sources, and we believe them to be reliable, but have not independently verified them. All information is subject to change, and any historical performance data does not guarantee future results. So what is a merchant cash advance? It's really the purchase of a portion of a merchant's future receipts in exchange for providing cash to the merchant today. Why are they needed? Well, few banks now currently cater to the need of small to medium-sized merchants for small and short-term funding. Even those banks who do typically require a lengthy period of time for processing and funding requests. Successful and growing merchants have unexpected cash flow needs that have to be met quickly, and banks are not able to meet their timetable. I'm stuck here, Scott. Here we go. Firms, which I refer to as funders, have stepped in to meet these merchant needs for short-term funding in a timely manner. Let's take a look at a hypothetical merchant called Joe, who owns a small oil delivery business, to see why he might consider a merchant cash advance.
Hey, Elliot, maybe before we get into that, just a quick question I had, kind of how long have, these types of, the merchant cash advances, how long have they been around? Is this something that's fairly new over the last 5 to 10 years, or is this something that's been going on for, throughout history in some form or fashion?
They've been going on for about the last 20 years, but really reached the boiling point after the financial crisis. Banks got shut down for lending, and even now with Dodd-Frank, the banks have a very tough time making small short-term loans to merchants. A lot of paperwork involved, as you'll see a little later in my example. They just can't profitably service this part of the market.
Yeah, and actually we had a question that popped up, I think, on that. Just someone said, is this buying into the factoring of the merchant account, or is this something that's a little bit different?
Well, an actual merchant cash advance is buying into the factoring of a merchant account.
Okay. All right. Again, I would encourage people to keep the questions coming, and Elliot, I'll turn it back over to you here to give us the example here.
Great. All right, Joe's got 3 trucks in his business, and he wakes up one morning and finds out that one of his trucks is broken down. He's got to replace it. He needs $50,000, and if he doesn't, he's not going to be able to complete his company's deliveries and keep his customers happy. He calls the bank for a loan, and they gave him a stack of papers to fill out. He asked them when he can expect a decision on his loan, and they reply, "Not sure when the loan committee is going to meet next. Sorry." This is not what Joe wants to hear. So Joe's in a bind now. He figures he'll be losing approximately $100,000 of profit over the next 6 months and have some very unhappy customers if he can't get a third truck on the road right away. Joe remembers that there's a funder called ABC Capital that might advance him the $50,000 he needs to buy this truck, possibly by the end of the day, so he gives them a call. After Joe gives them the information they request, ABC Capital tells Joe that they'll advance him the $50,000 that he needs to buy that truck, if he agrees to pay them back based on his future receivables over the next 6 months. Joe agrees and signs the paperwork and returns it to ABC Capital. ABC Capital then wires the $50,000 into his company's bank account. He picks up the truck the next day and he's back in business.
Elliot, just a quick question on that. If I can just, you mentioned the paperwork there. So obviously part of the benefit of doing a merchant cash advance is there's not as much paperwork or along a process as you'd find with going to a bank. The paperwork, kind of maybe give us an example of what some of the paperwork is that Joe would have to complete for the merchant to do a merchant cash advance, like what, as compared to obviously the bank loan.
Well, it's true. The real benefit of a merchant cash advance is the speed in which they can get the money. The bank's just going to take weeks, if not months, and in all probability may not advance him the money. In terms of paperwork, they look for last couple of months of bank deposits. They do an electronic background check on them. They fill out an application, obviously, but mostly it's based on cash flow needs as opposed to typically credit score needs and historical payback that you'd find in a normal loan.
Okay.
So here's a closer look at Joe's merchant cash advance. He's going to get $50,000 from ABC Funding. He's going to pay it back over 120 business days. The factor rate is 1.45, and his daily payment's going to be $604.17. And what this means is at a 1.45 factor, Joe will have approximately $604 debited from his checking or credit card accounts each business day over the next 120 days based on his receiving that cash advance today. So it's really, as you can see, more of a cash flow proposition.
Sure, and I mean you may get this, but how is that factor rate determined typically?
It's determined by the underwriters at the funders. They look at time in business, their experience with merchant cash advances in the past, obviously any assets that they might have, but it's mostly based on cash flow needs, number of deposits that they make per month, number of checks they write, that sort of thing.
Okay, so it was the higher a factor rate, then the more that individual is going to have to pay on a daily basis.
That's correct, but it's also the number of business days.
Right.
And in other words, if somebody were given 12 months to pay it off, obviously their payment would be less and they would be considered a better payment risk by the underwriter. Typically, somebody starting out might not get $50,000. Maybe they'd get $5,000 and they'd get it over 4 months and their factor rate might be 1.49. And as they get more and more experience, their factor rate comes down, the number of business days they're given to pay back on subsequent merchant cash advances increases.
Okay, so the number of business days and the factor rates, those are being set by the funding company. This is not something that Joe in this, for instance, can say, hey, I want to do this over a period of 9 months or 12 months, or do they have that type of input and then the factor rate then may go up or down, or kind of how does that process work when Joe comes to get the merchant cash advance and determining, how much back and forth is there?
Well, it is a negotiation. And ABC Funding in this example is not the only funder. So there is some competition that will drive down the factor rate and drive up the number of business days. But ultimately, it's up to the underwriters of each of the funder to determine just what terms they'll offer. And then it'll be up to a guy named Joe to see if he wants to accept it or not.
Okay. All right. Again, if we have any other questions, if any questions people have that are listening here, please make sure you get them typed into the chat box.
Okay, here are some of the industries that use merchant cash advances. We have oil delivery, like in our example, medical supplies, pet services, lawyers, accountants, doctors. And a lot of people say to me, why would a doctor need a merchant cash advance and increase his cost that way? Well, the doctor's time is very valuable. They don't want to spend the time filling out the paperwork, and they may need it for a machine in their office, an expansion of their business. If they can have the money tomorrow, and they don't have to spend hours and hours filling out paperwork and getting documents for banks, it'll be worth it to the doctors and groups. There's trucking companies, construction, dry cleaners, the list goes on and on. Many, many different types of industries. So how are merchants screened by funders? And we talked a little bit about this before. Each funder has its own proprietary method of evaluating merchants. In my experience, there are common items that funders look at to determine whether a cash advance should be made or not. Time in business is one. Percentage of funding request to annual sales. In other words, if a company's annual sales are $300,000 and they're looking for $10,000, that percent is 3% of their annual sales. Obviously, the lower that is, the more safe the underwriter is going to feel that the loan is. Excuse me, the advance is. They look at the last few months' back statements. They look at sources of deposits, frequencies of deposits, as I said before. They go through an electronic background check. And they do look at FICO scores, but they're much less important because this is basically a cash flow proposition. Even with these checks, there'll be a lot of merchants that will not pay in full. Successful funders have strong underwriting and collection teams that can minimize this bad debt, which I found to be approximately 15% of the amount collected. Seems high, but as you saw before, the factor rates compensate for that.
Yeah, Elliot, I had a couple questions just pop up from some of the attendees too. Someone who asked, I guess, you had the numbers there on the last example for Joe. With the factor rate, whatnot. Someone asked, how does this affect the usury rates in a state, kind of like the legal interest rate you're allowed to charge? How is this a little bit different from that?
Okay, well, these are not loans, so interest does not come into play. These are advances based on future revenues, so they are exempt from usury laws.
Okay. Another question is, how do these loans secured? Or are they
They're
not
not
secured at
secured
all?
typically. That's why the factors are so high. Typically, many times they'll get what's called a confession of judgment against the merchant, which basically says if they don't pay, they have the right to go after their bank accounts and cars and things like that. But it is not backed by any collateral.
One other question somebody asked is the factor rate that was in the example. Is that a fairly typical factor rate that you see for most businesses, or maybe how widely do those vary?
That is typical. They run from about for a really good funder would probably run on the low end 1.2 and on the upper end 1.5. And in terms of time, I've seen them go out 18 months, 2 years, but typically they're 6 months plus or minus.
And again, sorry, we had a bunch of good questions coming in here. I had to keep peppering you, but when someone asked, what is the annual rate of return typically? Like for instance, that 1.49 factor example, someone said it looks like around 7%. Is that it, or is the annual rate typically a little bit more than that? Like the annual rate of return?
Let me go back to this slide. Okay. If you just take the raw numbers, it looks like the return is 90% uncompounded. And keep in mind that the merchant is making daily payments. So that money that comes in daily gets to be reinvested. There are other expenses that a funder will have. They have some front-end expenses for people that source the business for them. There's back-end processing fees. But in terms of after all that's said and done, it's probably in the 40% range, I would say.
Okay. Okay, I'll let you jump back to the other slides. I'll ask you more questions when we get to that too. A couple of people asked kind of, I think you mentioned it here at the bottom of one of the slides, was what is the default rate typically? It kind of not only maybe across the board, but also historically in your particular experience with 1931 funding.
1931 funding, our numbers are running about 13%. But I like to quote a little higher, 15%. And when I model at 15%.
All right.
We all caught up?
Getting there, yep.
Okay. Okay, so here are my suggestions for how to evaluate a funder if you're going to invest directly with them. Whoop.
Oops, sorry. Go ahead.
First, do a Google search. Just make sure they're out there, they have a web presence, read about how they present themselves to merchants. Put a phone call into the office as a merchant. See how they treat you. Are they pushy? Are they really trying to help? That sort of thing. Ask for financials from the funder, especially a balance sheet and preferably audited. This will tell you who you're doing business with, how solid they are, and that sort of thing. If you can, visit the office, meet with the principal, find out the history of the business. Important, meet with the underwriting people and the collections people. Try and get a feel for how good they are. How long have they been there? What's been their experience? Ultimately, if you do work with them, you'll keep tabs on how well they do, and that'll be the ultimate test. But very important to get a feel for who's doing the underwriting and who's doing the collections. Ask for historical reports on performance. Look for bad debt to be 15% or lower, as I said before. So there's a number of ways you can invest in merchant cash advances. The first one is to actually just lend money to the funder at a fixed rate and term. The typical rates that a funder will pay you are 10 to 20% annually. Some will offer you monthly payments. The advantage of this is that you have a known return for interest and principal. The disadvantage is that if the funder defaults because of poor underwriting and collections, you're going to have a little bit of a problem. Another way is to invest in a fund that syndicates with multiple funders. The advantages here is you're diversifying that risk of one funder failing. The disadvantage is that it might offer lower returns because of that. And a third is to actually syndicate along with the funder. The advantage here is that you have a higher return, as you can see with the example with Joe. If you had underwritten that and Joe was good on his payments, you'd do a lot better than 10 or 20%. However, if Joe defaulted or had a problem, then you risk your principal. Thank you for listening. I'm open to other questions. There's a lot of risk reward that an investment in merchant cash advances offers. It may make sense for you to consider an allocation to it in your personal account or self-directed IRA. As I said, my goal here is to educate you on it so that you can make an informed decision. If you want to learn more, feel free to call me. Be happy to spend some time with you. You can call me at 610-999-3599, or you can go to my website, 1931funding.com. And on there, I have a 10-minute video, which has a little bit of what we went over today, but it also has a brochure that you can download. Also has financials from my fund that I offer to my subscribers. Don't want it to be a commercial, but just that's the way it is.
All right, Elliot, thanks for the information. We do have some questions here I want to make sure I get through. Let me say, someone says, since the confession to judgment issue has had a negative image lately, how do you make the merchant comfortable borrowing from you?
Well, that's an interesting question. There's been a lot of it written, especially in the series of articles in Bloomberg about it. The confession of judgment is something that a funder may or may not request of a merchant. The merchant can obviously negotiate with different funders, and maybe some will request it and some others. I know in speaking to the funders that I work with, they're moving more and more away from confession of judgment. But that is going to, in my opinion, I think that's going to happen over a period of months and quarters. I don't think that's going to be something that's going to happen overnight. Keep in mind that a confession of judgment is sort of what makes the advance safer than it would be without it. So that without a confession of judgment, certainly the factor rate would be higher, and certain merchants are just not going to get underwritten without it.
Another question, obviously the example you had, there was a daily payment, it was made over a course of 6 months. Do you typically have prepayment penalties for somebody who is actually going to pay off that loan? Maybe in that example, Joe needs the $50,000 and then he gets a windfall from, something that happens in his business and he pays it off after the first month, or is able to pay off. Is there prepayment penalties for those situations?
I have not seen any prepayment penalties. As a matter of fact, I've seen in the last couple of months written into the agreements discounts for prepayments. In other words, instead of the 145, if they pay it over 6 months, if they pay it back in 3 months, they'll scale down to 135 or 130 or something like that.
Okay.
It's relatively rare, but I've not seen any prepayment penalties.
I had a question for me. Somebody asked, they were a little late to join. Would the presentation be shared? The answer is yes. We are going to. We are recording this webinar. It will be available on our website, on our YouTube page, probably the next few days. Someone asked, when did you form 1931 Funding?
1931 Funding was formed March of last year. I had started prototyping this in the fall of the year before and spent 6 months using my own money to sort of see how it worked in real life. And once I went through a cycle, I saw that it was going to work out fine, and started with one funder and now have 13 funders that I work with.
Another good question. What do you do if the borrowers are late in their payment, and do you need to go to a court to actually collect any payments? Maybe go through that process a little bit.
Okay. Well, as a funder, which I am not, but as a funder, their first goal is to make sure that they leave lines of communication open. Even if they don't receive money, they want to make sure that they're talking to the merchant. Assuming they're doing that, there may be extenuating circumstances. There may be weather-related things, snowstorms, hurricanes. I find that most of the funders that I work with will allow them to suspend payments for a period of time because they understand that their business is not generating revenue, and it's frankly a good way to build good relations with the merchant for follow-on business. Oh, there was another part of that I wanted to answer. I can't remember it.
Okay, yeah, well, we can move on. There was a if it comes back to you, just throw it back in. Someone again, following up on that confession of judgment, it said that it's a person made a comment that I guess some of these confession of judgment enforcement can vary from state to state. Some states, don't. It says takes a dim view of those default judgments. So do funders tend to specialize by state, and maybe even extending beyond that? Do some funders specialize only by industries as well?
Well, I'd like to first say that I don't work directly with the merchants. My experience is only in working with the funders and looking at the deals and discussing them with the funders. Especially when a merchant is late, I'll want to know, what's going on and what's being done. There are certain states that are more friendly to confession of judgment. If you do reference the Bloomberg article, you'll find that there are one or two counties in New York where a lot of people filed because they are friendly. There's a whole thing with marshals abusing what's going on, but I think that is way overstated. Um, the bottom line is that the funder wants to be paid by the merchant, and if the merchant cannot pay, they will do everything they can to put in a modified payment plan for the merchant to something that he can afford. Again, the most important thing is for the funder and the merchant to be able to communicate and work towards a solution. If that doesn't work, then of course they file. If there's a confession of judgment, they'll file the judgment, they'll sue them, and sometimes that will get them to respond before anything further happens. Each case is unique, obviously.
Yeah, and someone asked as well, follow up on that. If you have that, you mentioned a Bloomberg article. If that's something you could provide a link to, maybe if you send that along to me, Elliot, I can make sure we get it out to the individuals as well. One other question, and again, I invite people. We're kind of getting close to the end here. If you have any other questions, make sure you get them typed in. If you are syndicating with the lender, and there's a failure, kind of, I guess, obviously a default, does the loss typically get split between the person you're syndicating with, or how does that work in most scenarios, at least in your experience or to your knowledge?
Sure. Well, I'm syndicating on every deal, so I know firsthand how that works. If let's say with Joe, let's say I decide to take 10% of that, which is 5,000. If Joe stops paying, then I'm going to suffer 10% of the loss. Every time Joe makes a payment, I'm getting 10% of the payments. So if Joe pays 5% of his loan and then, excuse me, of his advance, and then he disappears, then I'm out 95% of my principal on that particular advance. And that's why it's so important to use the law of large numbers and have many different advances that you're invested in, because just like in a stock portfolio, you never know which one's going to blow up. And you want to use the law of large numbers to your benefit.
Again, you kind of mentioned this already, but just to be asked again, what do you do if the borrowers just walk away without paying? Maybe just cover that again quickly.
Sure. They will try and contact the borrower after a period of time. They'll turn it over to their legal team, which will, depending on the documents that are filed, either file a confession of judgment or put in for a default judgment or whatever they feel is appropriate. And the funders will then follow up on a periodic basis with their legal team to see if there's any change in status.
A question, I guess, and maybe this might depend on how somebody invests, whether it's an IRA or personal or whatnot, but how they invest in a merchant cash advance. But does the investor receive typically daily deposits if they're being made, or is that, again, I think based on the three different ways you showed to invest, I'm going to guess that answer is going to differ greatly.
That's right. If you syndicate along with the funder, then the funder will pay you daily or weekly, depending on how they process their payments. If you work with a fund, you basically are signing a note, and your payment is independent of whether the merchant pays back the funder or not, because you've signed a note, and the note says they're going to pay you 10% per year for every dollar you put in. They're going to pay you monthly. And at that point, you really don't care whether the merchant pays or not. What you care about is if the funder has the funds to make your interest payment, and then at the end, make your principal payment.
All right. One more question, Elliot, unless anyone gets another one in here quickly. Someone just asked, is there a minimum or maximum amount for a merchant cash advance, and then also is there minimum or maximum amounts for an investor who's looking to place that money? And again, maybe
Well,
just on your own personal experience and kind of how you've operated.
the smallest merchant cash advance that I've seen is $2,000. I don't think I've seen anything below that. In terms of syndicating on that, that's really up to how you work it out with the funder. In terms of working with a funder where they issue a note, they'll have their own minimums. They tend to be, from what I've seen, $10,000 for smaller ones, $100,000 for others. Again, it goes all over the board. I can tell you at 1931, I'm into my second offering, and I'm still at $10,000 for a minimum investment.
All right. Well, actually, Elliot, there was your bio on the next slide. Anything you want to highlight there before we wrap up?
Don't hold working for General Electric against me.
All right. We won't. I guess maybe any closing words that you'd have for us.
I do. This is an alternative investment. It should be a small part of your overall portfolio if you choose to allocate to it. Start small, like you would with any investment, and learn as much as you can and ask lots of questions, and don't invest in it till you are comfortable that you understand what you're getting into.
Oh, good. Elliot, again, thank you very much for coming on today and again sharing with our listeners just yet another way a self-directed IRA can be used. Again, it's something we haven't had anyone speak on before, so I appreciate you sharing that with us. Very good information.
Thanks, Scott.
Good. And to everyone who's listening, thank you again for participating. My contact information is on this last slide. If you have any other questions about self-directed IRAs, please reach out to me. As well, again, this webinar is being recorded for those of you listening live, and we'll send that recording link out. For anyone who's listening to the recorded version, please reach out to myself or Elliot with any other additional questions. And thank you again for attending.